I'm Olivia Voznenko.
I'm Steve Guilfoyle. This is Street Smarts. You know what day it is today, Voz?
It's Thursday, which is
What
weird
else is
because
it?
usually we're on a Tuesday.
That's right. It is earnings eve.
Ooh.
Probably the most heavily anticipated earnings season in quite some time. And the banks will lead off tomorrow. Citi, JP Morgan, PNC Bank, Wells Fargo, several of them. But the markets are rocking. The markets are rocking a couple days in a row here in anticipation.
Yeah, because it's going to be could be the strongest earnings season that we've had in nearly a decade.
On top of that, we were going to war yesterday, so they propped up oil and defense, and those propped up the markets.
Yep.
And today we're not going to war.
And now
so they bought the markets.
Oil tanked and now it's up.
Yeah, is it $67 a barrel yet?
I have to check.
Don't worry about it. We know it's between 66.5 and 67. We know that the energy sector has seen quite a boom. In fact, I got out of my Apache position finally. I was dragging that thing along for quite a while. But,
that took you on one heck of a ride. You had some nice calls there, Steve.
That actually, that was quite a job, actually, working my way out of that position. So it may not be the most profitable thing I've ever done, although it was profitable, but it was probably the one I worked the hardest on, and we got out of it safely. So that's a good thing anyway.
Yeah, for sure. And ahead of the banks, you are bringing on a special guest. So before we introduce him, is there anything else that our viewers need to know that we should cover?
Where should we go with this? I mean, the macro has been, I would say, interesting of late.
He's telling me about the macro. That is quite a tricky one.
Well,
some people say it's positive. I didn't view it as that positive.
You're seeing it both ways. I think we've seen weakness in spots. Obviously, so is the Atlanta Fed. Otherwise, the GDP expectation for the first quarter wouldn't be down to 2.0%. They're expecting less participation from the consumer based on the jobs data. CPI. Yeah, the year-over-year numbers came in on consensus, but the month-over-month numbers didn't, so it's a little bit of a mixed message there. And I don't know how much you can expect the consumer, who they're admitting is under some stress, to take that all that much higher, not at least not based on demand. So I think it's really going forward, it's something where the Fed is going to be in a conflicted situation if they continue on their path towards 3 to 4 rate hikes, and if they continue on their balance sheet management program.
And then given the fact that we have this massive fiscal stimulus, it's very insane.
And that has to become an issue at some point.
Sure.
I mean, it'll help some of the stocks we're in.
Yeah.
It should help some commodities, no doubt about it. But I think going forward, it certainly does become the bogeyman.
The bogeyman. And in the meantime, we have a flattening yield curve.
That's true. And then we're going to talk with our guest about that in just a few.
Yes.
So on that note.
Can we introduce him already? I'm going to have you introduce him because I think you're better at this.
Well,
I'll give you a shot, Guilfoyle.
We have a special treat for you today. We have, from Jim Cramer's Charitable Trust, Action Alerts Plus, Jeff Marks, Senior Portfolio Analyst. And this guy knows his stuff.
Jeff, great to have you on. Thank you so much. So we get bank earnings tomorrow. Do you think that they're going to beat, or is the bar raised too high and they're priced for perfection?
Yeah, well, first off, thank you for having me.
Of course.
So I think heading into earnings season, I think we can really almost take a sigh of relief right now. Usually it's the other way around. When we're into earnings, we take a sigh when it's over. But I'm excited for this earnings season because right now the market has starved for a catalyst. Right now, everything's sort of it's very headline driven right now by what's going on in Washington and tweets. And right now we can really get back into the fundamentals of the market. We can start talking about companies again. And I think, we have the banks leading off tomorrow. And I think they're, fundamentally speaking, I think there's a lot of positives we can talk about them, which I'm sure we're going to get into. But yeah, I'm excited for this earnings season. I don't think it's priced to perfection because I think there's been a lot of people who have been hesitant to get into the market. So I think that is sort of, there's room for multiple expansion. We'll put it that way.
Yeah, I think the compressed yield curve, which is now trading around 48 basis points between the 2 and the 10-year, has actually scared some folks out of the banks. Speaking for myself, I'm long a few banks, but I was long Bank of America, and I decided to cut them off. I cut it down to a few names, which Jeff will be getting into. But I got rid of the Bank of America just because I didn't want to be overexposed to the space if the yield curve compressed any further.
You backed out of Bank of America.
You bet. But that said, trading's going to be
Yeah,
got the
and
hot ticket,
I think when you look at with the yield curve though too, is of course the banks, whenever we see the rates are going to go down, they're going to sell off some. I think that's a lot of people trying to work their way into that. But when we talk about the banks right now, we are in a rising interest rate environment. Short term, the Fed is raising short term rates. We had one in December. We had one in March. They're expecting maybe 4 to maybe even 5 this year. So
Hopefully
I think
not even 4. That's my
right. Well, I mean that's the thing. It's almost counterintuitive when you see the rates go higher. People are going to be inclined to sell off, but at the same time, there's a group that really should benefit from these higher short-term rates.
Do you think if they succeed only in pushing up the short end, if the bond market controls the long end and it doesn't play ball, do you think they could accidentally cause a recession?
Look, I think that the market likes certainty, right? And when the rates don't exactly play into how they plan on it being to be, I think that causes a little bit uneasiness, and that uneasiness is going to cause some selling. So there is a risk that with some credit tightening and some the inversion of the yield curve, that maybe we might see some softness there. But I think ultimately, these banks, these hold large deposit bases, and ultimately the net interest margin will increase from that. And it's good. It's exciting for the banks. Maybe the at-home investor might be a little bit uneasy, but there's a lot of activeness back into this market right now, and that plays to the bank's favor, right? These large banks, Goldman Sachs specifically, one that we've been buying up all during this market downturn. They act as a market maker. So when there's more trading volume, they're making money off that.
Yes, I'm so glad. Can I jump in?
Go right ahead.
Can the lady jump in? Yeah. I'm so glad you bring that up because, yes, volatility did pick back up, and that was hurting banks' earnings last year. But a lot of them remodeled. So did they miss out?
No, I don't think so. These banks, they know exactly how to position themselves when the opportunity strikes. And I think when you have a firm like Goldman, who is, trading is a big part of their company, I don't think they've been sitting on the sidelines during this type of
At least we
event.
hope not.
I hope not.
Well, we'll see.
I'm along the name also. I sold 40% of my Goldman a couple of weeks ago, and I bought back the portion I had sold on the recent downturn ahead of these earnings, thinking that if anybody could trade this market, it's going to be Goldman. I mean, can they restore their reputation?
Sure, and 2017 was the lack of volatility in the market really put Goldman, they put up some disappointing numbers when it comes to trading. But I mean, when you look at these year-over-year increases, and we've had more 1% swings in the market so far this year, double the amount so far this year. So again, that really plays into the volatility swing.
I believe 18 of the last 22 days have seen a 1% move in the Dow.
Unbelievable. I have written down 41 of the 61 days in the first quarter, right? And that's from 20 and 2017.
So who doesn't that help as much in the banking space? We know we think it helps Goldman. I would imagine it helps JP Morgan a whole lot. Mm-hmm. Does it help Citi as much? Does it help Wells Fargo at all?
Well, so it will still help them. Citi isn't as reliant on trading revenue, and that's also a reason why we've been holding it for Action Alerts Plus, because with Citibank, they're not as reliant on volatility, so they'll play into some other themes. Like they have a very underappreciated investment bank. So we're seeing a lot of transactions occurring in 2018. So that's sort of where their strength plays into. Same with loans, and they have a very large deposit base as well. So volatility is more for the investment banks. That's going to be the Goldman Sachs. That's going to be the Morgan Stanleys. Whereas the larger, the commercial banks, the JP Morgans, Wells Fargo, and the regional banks like a PNC, for instance, not as much.
M&A is kind of getting hotter again, isn't it?
Yeah, it's absolutely picking up. I think sentiment was really high in the first quarter. There was a lot of big transactions. We've seen companies like Broadcom try unsuccessfully acquire Qualcomm, and I think that really sort of plays into the livelihood of the M&A market. Plus tax reform, a lot of these companies are going to have really big cash windfalls. They're going to want to put it to use. I think M&A is definitely something to keep our eye on.
And that's just that the blackout window's gone now too, so these banks will probably be active on their own behalf very shortly.
You don't think regionals would prosper given the tax cuts?
No, I do think regionals are set up to perform well. I think again, it's fundamentally speaking, there's a lot of good things going on in the banks. I am more focused on the more large international, multinational commercial banks. But I do think PNC is absolutely primed to set up a good number. They have, really good regional exposure.
And what about valuations? A lot of people can't agree if valuations are, if stocks are cheap, if they're expensive. I saw a lot of bank analysts like yourself believe that banks are pretty fairly priced right now. Would you agree with that?
No, I would probably argue that they are. I would argue that they are underpriced. I think that when you look at relative to the S&P 500, they're a very cheap group. You have J.P. Morgan trading 10, 11 times next year's earnings. Goldman Sachs a little bit below that. Citigroup, they trade roughly on par with their book value, which is really when you think these banks are growing their book values year over year. Anything around there is generally seen as a buying opportunity. You had Jamie Dimon on his shareholder letter that he released not too long ago. He was saying he's willing to buy JP Morgan stock over 2 times book value. So I think that's really a strong signal of that.
I think it is over 2 times right
yeah,
now, right?
It's just above 2. So JP Morgan, they're probably one of the more expensive names in the bunch, but that's because they also have the best return on
they have the best reputation. They
Exactly.
have the most high-profile CEO. They are considered to be best in class by most people.
Yeah, and I think it all goes back to their fortress balance sheet, right? They have tons of capital reserves, tons of equity ready to sort of withstand any turbulence that might occur.
You know what I like about Citi too? I'm long Citi. I'm long JP Morgan. I'm long Goldman Sachs. I like that Citi has promised to return so much to the shareholder.
Yes.
That's kind of, during the shakeout, that's one reason why I didn't shake out. I stayed long the name.
Absolutely, and I think that Citi is definitely a very strong candidate to increase their capital returns. Especially, there's a lot of deregulation going on in the industry, right? So we're hearing maybe they're going to scale back some of the stress tests, some of the capital reserves.
That could actually be a negative to some of the bigger banks. The way the stress tests are going to be designed in the future could actually force some of the bigger banks to have higher levels of reserves. I read that in the Journal today, I believe.
It's a very interesting, outlook there. But I also think that if they can hold less of their capital reserves, they could return it back to shareholders. And a lot of it right now has been shareholder share buybacks. But if that turns into dividends, I think the payout ratios can really increase. I think you're going to see a lot of multiple expansion in the banks.
And that's a positive for the regionals you were just speaking of.
Yeah.
Maybe that's a reason to get back into key.
And their earnings, right? Buybacks help their earnings, correct?
Yeah, so it's a modest accretion to the bottom line. But we're really hoping everything right now has been the buyback program. I'm holding out for some type of dividend increase. I don't think we're going to hear it on these conference calls. Maybe we'll get some insight. Usually these types of capital return programs coincide with the stress tests that are held in the summer. So we'll have to wait till then. But again, these banks, off of tax reform with the lower tax bill, huge cash windfall. What are they going to do with the cash?
Yeah, did you see the IMF is talking about broadening the use of the SDR?
I did not see that.
That would be horrible. You would think it would weaken the dollar, but I guess it would weaken almost every reserve currency. But I guess the dollar being the number one reserve currency would weaken the dollar the most. So
that's been kind of the gossip for a while, though.
Yeah, it's like a Jim Rickards type thing. We need to talk to Jim about that.
Yeah, definitely.
And the dollar is an interesting dynamic right now because you have Larry Kudlow moving over to the White House, and he's a king dollar philosophy,
guy.
right? Mm-hmm. But a lot of these, especially some of the multinational industrials, they've benefited from this weaker dollar as well with a lot of their overseas sales. So we'll have to see how this plays out into this earnings season.
I still see a weaker dollar, and that's basically because the currency guy I read happens to be Douglas Borthwick, and he's been right about a lot, and he still sees the dollar having downside from here.
Yeah, he's a great Forex guy.
There's a couple things to talk about today, Voz. All right, defense and retail. I know they don't go together very well, but I think it's important to point out that in this show a couple weeks ago, I stuck up for a drone company, a military contractor named Kratos Defense. The stock was trading down into the low 9s. And I actually bought some that day right in front of you. Not to toot my own horn, but the stock's trading above $11 now. The stock has come back significantly from that downward call by the short seller, I think it was Bryce Point. Defense has been very hot because of the president's tweeting on the Syria situation. All right, I think Lockheed is at the forefront. The Indian Air Force wants to buy fighter planes. Lockheed has a very good chance to sell them the F-16. They also have the F-22 and the F-35. Both of those planes are stealth capable, which means that the Russian, I believe S-400 intercept systems that are deployed in Syria can't shoot them down. So we are well prepared if something does happen in that neighborhood. I also like General Dynamics, which is, if you ever heard of the Virginia-class submarine, that's their baby. And I also like Raytheon. Raytheon is a name I'm also along, which
You've been very bullish on that.
yeah, they just signed a couple weeks ago, a $4.75 billion contract to supply Patriot missiles to the Polish government. It's the largest military purchase in Polish history.
Wow.
So a lot of these names have something going for it. It's global, as I just mentioned, with India and Poland. It's not just the U.S., but defense spending is on the rise almost everywhere. A couple of ETFs for the home gamers that may not know whether to pick this or pick that, or maybe you're afraid of Boeing like I am because of Chinese exposure, even though the stock keeps going up. ITA and XAR. XAR is the spider, and it's evenly spread out. All the stocks in that fund are 3.3 to 3.6% of the weighting. And ITA is the iShares. That one's not as evenly spread out. Boeing's about 10% of the fund, so it's a little more risky, but there could also be a higher reward.
Well, defense is not my area of expertise, but I do know retail. Now, Stephen, we are running a little long today, so maybe we can leave that for next week's market rush. We can do like a little co-market rush in retail. What do you say? Are you up for the challenge?
I'm always up for the challenge.
So you want to do that?
Do it next week?
Yeah.
No.
Really?
Well, the whole situation could change by next week.
I don't know. My situation,
You see,
with earnings season.
with oil peaking, there's potentially less money in the consumer pocketbook. So, myself, I sold one of my favorite retail names this morning, Kohl's. I'm out of the name right now, although it's probably my favorite retail name. But I don't like oil trading around 66, 67, almost, who knows, it could go to $68 a barrel, WTI crude. If that raises gasoline prices, the already strapped U.S. consumer, who's already in a tight spot, could get even more squiggly as we go forward. What does that mean to the retailers? The only retailer I still have is Walmart, and I don't have a lot of it, so I'm underexposed in the space. I'd like to buy back the Kohl's if I get a price maybe in the mid-50s. I had to sell it around here at 63, but that was just my own personal discipline. But I do like the name. But given that Kohl's may not come in, I'd like to hear from you.
Yeah.
What should Sarge buy in the retail space going forward?
Ooh, I like that. I mean, it's funny that you mentioned that and you make a very good point about oil. We're already seeing those gas prices rise. Someone tweeted that they see oil going to $80 by the end of the year. That's crazy to me, and yeah, that could hurt retail. But something I tweeted out to our followers was, what did you almost buy before everything started going crazy? Before everything started going crazy. And mine was actually Nike. And I mean, I wouldn't buy it now. It's too expensive for me, obviously. But yeah, it was Nike.
I'm not crazy about apparel manufacturers, but that's an interesting call. Certainly better than Under Armour, in my opinion. Certainly, the real competition there, I guess, comes from Adidas.
Right. Well, sneakers are now the trend. That's the thing. Like, athleisure is not dead. We kind of talked a little bit about this. It's not dead, but rather shifting, as my buyer friends told me. So,
are you an athleisure person?
I'm a trendy person, so I'll go with the trend. If they're telling me to wear sneakers with jeans, that's the new thing. Like ditch the matching zip up and stuff from Lululemon, then I will do that. Rightfully so. So yeah, I'm looking at sneaker stocks.
Wow, very interesting. I am flat the sneaker sector.
Celebrity-backed sneaker stocks, but we'll just take a look at that. We'll monitor.
We'll monitor. We'll actually update that next week, perhaps.
All right, perfect. So he will take the next week's challenge.
Well, hopefully we'll get some tweets and some emails, and we'll find out what retail stocks the folks have in mind for me, because I'm underexposed in this
Definitely
space.
stirs up a really cool discussion. All right, well, that about wraps it up. What do you think, Stephen?
I think we're done for today.
Thank you for tuning in, guys.
We always appreciate it.
Later.